if, and you still put a conditional if on this, we are moving into a higher rate and also higher inflation environment or regime, as you like to point out, there is significant mispricing with the 10, let's say, for example, it's still at 160, not just in that, but also in vol.
Yes, absolutely. And the way we're playing it, or the way we're hedging it, if you like, is to actually have a long basket of bank equity in Asia Pacific. So that's one of our core positions, about 25% of the portfolio in a basket of 50 banks across the region. Banks tend to improve their net interest margins when interest rates rise. And so they tend to be positively correlated to bond yields and therefore a hedge. The other point, of course, is the banks in the region, well, certainly our basket trades on 7 times forward earnings. So it's incredibly cheap, roughly a 50% discount to the region and a massive discount to global equity. And also has a very, very strong dividend yield. So it's a positive carry way of having a hedge on higher interest rates.
Okay, sounds good. It makes sense to me. What about the flip side, though? That is names that could suffer in a rising rate and also higher inflation environment. I'm thinking obviously here of mega cap tech growth, for example, with discounted cash flows, and also basically anybody that's borrowed maybe a little bit too much.
Yes, absolutely. So on the flip side, what we're concerned about and where we've created a short basket, we haven't actually implemented that yet, but we've focused on the companies that have extremely expensive valuation, negative free cash flow, and high balance sheet leverage. So highly levered entities, as interest rates rise and liquidity gets withdrawn, are much more vulnerable. And to be fair, we think that that's more in the non-profitable tech universe rather than the profitable tech universe, although it's highly plausible that the NASDAQ itself, even mega cap tech, actually corrects a bit. In contrast, though, we would actually say that tech in Asia trades at a significant discount to US tech, and it's already materially underperformed, as you guys know, this year or so far, year to date. And actually, if anything, we're starting to add a little bit more in the platform stocks in China. So we've got an Asian tech basket as well, so we've got a little bit of a barbell. But as I said, Asian tech trades at a massive discount to US tech and actually looks interesting from a value perspective now.
Nick, let me just pick up on that point about adding a bit more exposure in China. What about China high yield? Should we be cautious heading into 2022 or somewhat constructive?
Yeah, that's a great question, Sri. Actually, 2 weeks ago, we added high yield for the first time in over 12 months. So we'd been, I think the last time I was on the program, we were highlighting our caution, and it's certainly played out in terms of spreads, particularly in China, high yield blowing out well over 2,000 basis points. And we actually took that opportunity to add a position in that. We've done it in Asian high yield. We've used the BlackRock ETF, which is listed here in Singapore, AHYG, which is roughly 40% China high yield. And actually that's started to recover already. Our sense is that the credit impulse in China was roughly near a trough, and it does appear as though the Chinese authorities are starting to indicate that they will support the market a little bit, or at least provide liquidity, make sure that it's at least functional. That's not to say that we don't think that this is a genuine problem, by the way. The leverage in that part of the Chinese housing market and in the property developers is very, very large. But of course, that's why the spreads are trading at over 2,000 basis points. So we think a decent proportion of it is actually in the price now.